Welcome to Investors Insight, where today's topic is oil tells the story. A lot going on. The market volatility has really spiked in the last 2 weeks. And at the core of the reason for the volatility is the price of oil climbing higher. So let's get into it. Trey, talk about the price of oil, what the impact that has on the consumer. And then also, we've been talking about these tax refunds. What impact does higher oil prices have on that as well?
Yeah, thanks, Bobby. So coming into this year, one of our big themes was that the U.S. consumer is going to have a nice tailwind of additional tax refunds from the tax bill that passed last year, the no tax on tip, no tax on overtime, the SALT deduction. That was really going to help the U.S. consumer with a boon of funds coming in their tax refunds. And so far this year, that has occurred. Tax refunds are pacing at around $24.7 billion in additional funds going into the U.S. consumer compared to this time last year. The trouble is that, like you were talking about, the price of oil has spiked at a time when people are getting these tax refunds. So while it hasn't eaten up the entire refund, it is putting a dent in it. Estimates range from around $5 billion is how much the U.S. consumer is absorbing from additional cost, specifically in the cost of gasoline. So how is that possible? Let me break down some numbers real quick. The U.S. uses about 380 million gallons of gas every single day. So a 57-cent increase in the price of gas per gallon equates to around $218 million a day. And so that's how you get to about $6.5 billion so far as that's added up and prices continue to go higher. So it hasn't completely eaten into the $24.75 billion in additional tax refunds, but it's certainly putting a dent, and it's making the U.S. consumer a little less willing to go out and spend. We actually saw the U.S. savings rate go up, so that tax refund isn't flowing through to all parts of the economy. A lot of it seems to be focused on that oil patch, which isn't necessarily a negative, but if it continues, definitely is not what we're looking for.
Yeah, well, consumer spending matters for the economy and the market. So definitely something we're watching. And also with markets still under pressure due to the Middle East conflict, we took a look back to see how the prices of oil acted back in 2022 when Russia invaded Ukraine. So extended higher oil prices would be a concern for market performance. So we'll continue talking about this, analyzing it. And as you can see in this chart, looking back to February of 2022, when Russia invaded Ukraine, along with the current events, Brent crude has mirrored its 2022 behavior. And so prices of oil went from $65 in early December to a peak of $139 as the war unfolded in 2022. Similarly today, the conflict in Iran drove prices from 60 all the way to 120 a barrel seen on March 9th. And prices have since retreated as tanker traffic through the Strait of Hormuz resumed. Bottom line, uncertainty over the duration and intensity of the war in Iran remains very high. And so oil's implied volatility is elevated, but the comparison to 2022 suggests peak prices for this event may have already been behind us. So, but the Strait of Hormuz makes the Iran war fundamentally different with supply risk. We see the current prices of oil coming down as a positive sign, not only for a potentially better than feared resolution, but also for oil markets and the broader equity market. So, Ty, talk about the impact of higher oil. And the main point here is that the Fed meets. Not a lot of people are talking about the impact the Fed has and the potential decision based on higher oil prices. Talk about that.
Yeah, we're usually so Fed focused. We know when they meet, each and every time. But this week has kind of, come up on all of us, I would say, with everything going on in the world. But the Fed does meet this week. The expectation is no action for right now as we still wait for that transition from Jay Powell to Warsh. But an interesting chart here, as you can see, is coming into the year, we were expecting about 3 rate cuts, or at least that was kind of what the market was implied to be pricing in. We're all the way down to less than 1 rate cut expected for the year. So that's a pretty dramatic kind of shift there. Why is that? Well, oil has really, I think the inflation fears are starting to get to the market, and so oil generally, while we are feeling that inflationary pressure, keep in mind that generally the cure for high oil prices is higher prices. Oil is typically a one-off event, doesn't necessarily lead to sustainable higher inflation. And typically, the U.S. economy has slowed down once once oil prices get this high, and we've started to see that a little bit. Now it's still a little early to tell, but real GDP was revised downward from 1.4% in the fourth quarter to 0.7%. So growth is slowing a little bit. Typically, higher oil prices, though, do once they start coming down, since they're one-off events, necessitate the need for more rate cuts. So right now, good news for you savers out there is that rate cuts are not expected to, only maybe one for this year. However, we're going to keep our eye on this because it may change, and that would be good for borrowers if we get more in the 2 to 3 rate cut range.
Yeah, so look, oil tells the story. And so higher oil prices impacts consumer spending, it impacts what the Fed's going to do, and it impacts the market. So we're going to continue to follow oil prices closely here to see what long-term impact it's going to have. So if you have questions about anything we've discussed, please call us, email us. We love to hear from you. Have a great week. Thanks for watching.